Hello everyone and welcome back. Thank you for joining today's sessions. We are diving into a fascinating and crucial aspect of the financial world, repurchase agreements, or in short it is called as repos. Repos are one of the backbone instruments in the global financial markets. It provides liquidity, reduce risk, and allows institutions to trade and manage their portfolios effectively. By the end of this session, you will have a clear understanding of repo transactions, how they function, and their significance. In this session, we will cover the fundamentals and look at the key variants of repo. We will discuss the repo interest, haircut, margin, and we will also explore the repo clearing mechanism. On top of that, we will discuss advanced trading strategies in repo market, the regulatory frameworks governing repos, and how these instruments are used during different market conditions. Let's start with what is a repo. At its simplest, a repo transaction is a type of short-term borrowing. In this arrangement, one party, usually referred to as seller, sells securities, typically high-quality bonds like government securities, to another party, that is the buyer, in exchange for cash. However, it's not a straightforward sale. The seller agrees to repurchase the securities at a future date for a slightly higher price. The difference between the initial price and the repurchase price is essentially interest, and it's called repo interest. In this structure, the seller gets cash immediately but agrees to buy back the securities at a future date. The buyer provides the cash and earns a return via the repo interest. So, in essence, repos are collateralized loans where collateral is the securities being sold. These transactions are commonly used to raise short term cash, often for period ranging from overnight to a few months. Repos are highly favored by financial institutions because they are a safe and efficient way to manage liquidity. Now let's take an example. Bank A need cash, so it enters into a repo agreement with Bank B. Bank A sells 10 million worth of US Treasury bond to Bank B for cash today. The agreement specifies that Bank A will repurchase the same bond in 7 days at a slightly higher price. The higher price Bank A pays reflects the interest. The key thing to note here is that while the bonds change hand temporarily, the underlying ownership remains intact because Bank A is obligated to repurchase them back. Now let's understand the repo interest. This is the interest that the seller, that is the party borrowing the cash, pays to the buyer, that is the lender, for the duration of the repo. It's calculated based on the repo rate, the amount of cash provided, and the length of time that the repo lasts. Okay, let's take an example. Okay, first let's understand the formula. This formula is very simple. It's very simple interest formula kind of way. So its repo interest is uh, same as start proceeds, that is the initial amount that was borrowed times the repo rate, that is the rate of interest that is getting charged, the repo period, how long the loan will last, and divided by day count basis. So generally, different jurisdictions has different day count basis. For US, suppose an example, it takes 360 days basis. European countries generally have 365 days basis. That day count basis we talked about it in the last um, session when we talked about the instruments and their pricings. So let's take an example in this case. Suppose the bank A sells 10 million of bonds, but because of the bond price, it receives $9.8 million in cash. So bond price contains, uh, actually this is a bit advanced topic, but there is something called as dirty price. This is the actual price of the bond. It might be higher than the uh, bond values, that is the face values, or it might be lower than the face values as well. So that is the value of the bond, that is the actual values, the actual cash values of that bond, and it is called as dirty price because dirty price incorporate the coupons that you will receive and all those things. Now the repo rate is 2%, suppose, and the period of borrowing is 7 days because repo transactions generally happen for a very short duration time. So if you calculate it using this formula, it's the repo interest will come out to be around $3,800.22. So at the end of the 7 days, the bank A has to repurchase the bond for 9.8 million $3,800.22. The extra $3,800.22 represent the interest bank A is paying to short-term loan. And this is why a repo is considered a secured borrowing, as the securities like government bonds act as a collateral for loan. Okay, now let's understand about the haircuts. A haircut in repo terms refers to the discount applied to the value of the securities that are being used as collateral. This haircut acts as a risk buffer for the lender, that is the buyer of the securities. The purpose, okay, so let's first understand how it's work. The market value of the securities sold as collateral might be $10 million. Okay, but due to market volatility or credit risk, the lender might only advance 95% of this value. So this 5% difference is the haircut. In this case, the lender would provide $9.8 million in cash against the $10 million in securities. Okay, so last time in the last slide that we talked about, we said for a $10 million worth of securities, we are getting a $9.8 million in cash. That is because of the bond prices. So basically, the bond values, the face value is for 10 million, but the bond actual values is coming to be around 9.8 million because of uh, some reasons. There are multiple reasons that can happen, the yield curve and all those things. We are not going into that detail. This is not haircut, this is the actual price of that collateral that is getting used. In the haircut, the situation is bit different. In the haircut, we are saying that whatever is the price of the collateral that you are providing, we are going to take certain haircuts on top of that. So basically, if you provide me a $10 million of bond, I will apply a 5% haircut on that one, and I will provide you $9.5 million in cash against this $10 million security. So the purpose of this haircut is twofold. First, it protects the lender from market fluctuations in the value of the securities during the term of the repo. So suppose because the bonds are securitized products and its values will go up and down. So if its values will go down, the lender will be protected. And because this is a very short term uh, money market instrument, generally we do not expect the bond market to fluctuate that much. So the haircut won't be that substantial, but there there is around 4%, 3%, 2% kind of a haircut that will happen. So that's definitely there. Also, the second point is that it incentivizes the borrower to repurchase the securities, since the securities are technically worth more than the cash they received. So basically, if I have borrowed something from someone by paying, giving something which is of higher values as collateral, I would want that collateral back, right? By paying my money. So that's the second incentive. Now let's understand it through an example. Let's say Bank A enter into a repo agreement with a 5% haircut. Bank A wants to borrow cash against $10 million worth of US Treasury bond. And due to this haircut, Bank A will only receive $9.5 million in cash. If the value of the bonds drops slightly during the life of the repo, the lender is protected by the haircut. And if for some reason, though it won't happen, but if for some reason the borrower defaults and does not purchase the security, repurchase the security back, the lender can sell that security and still be able to recover the cash it loaned, even if the value of the securities has dropped by a small percentage, right? Now let's understand the margin and variational margin. In addition to haircut, repos often involve margins. So margin serves to ensure that there is a sufficient collateral backing the loan throughout the loan life of the repo. So there are two kind of margin. That is the initial margin. The initial margin is an over collateralization at the beginning of the transaction, typically higher than the loan amount. Then there is a variational margin which comes into play when the value of the collateral fluctuates during the repo period. The value of the collateral is marked to market daily, and if the value falls below the required level, the borrower must either post more collateral or return some cash back to the borrower. Or on the other hand, if the collateral value rises, some of it may be returned to the borrower. Now let's understand it through an example. Let's say Bank A collateral fall in value by 2% during a 10-day repo. If the initial margin was 2.5%, the lender might require Bank A to post additional collateral or provide more cash to restore the margin. This system of margining ensures that lender is adequately protected at all time. So let's try to understand it. We understand three things. One is the dirty pricing of the bond. So that is different from the face values of the bond. This is the actual price calculations of the bond that you are gonna receive if you hold that bond till the end or the current price of the bond. Okay. So including the coupon payments and all those things. So bond pricing we will discuss into later on, actually much later on when we went through the bonds and the yield and all those things. We will look into that one as well. But for the right now, just understand it as the value of the collateral. So that is the first part. The second part is uh, there is a haircut. So suppose you have a $10 million of bond with a actually current market values of 9.8 million dollars. Okay. Now on this $9.8 million, if I say that I will take, suppose, 5% of the haircut. Okay, now, okay, for simplicity, though it won't happen in practicality, but for simplicity, let's say that we take 1% of the haircut. Okay, when we do 1% of these bonds, it will reduce the price by uh, 9.7, close to $9.7 million. Okay, so now ideally you should get a cash of 9.7 million, but that won't happen because on top of this 9.7 I will require some margin and some variational margin. So suppose the margin is 3%. Okay, this is the initial margin, and on top of that there will be something called as variational margin, and the variational margin might be on top of this 3%. So suppose 2% is the variational margin. So now again the 5% will be reduced from 9.7 million. Okay, so the now the cash that you will actually receive is $9.2 million. And during this period, what happens is that if the value of the bond, which was initially 9.8 million when we deposited it, its face value is 10 million, but the actual value in the market at the time when I have asked for a loan was 9.8 million. Now it has been reduced to 9.6 million. Okay, suppose now it has reduced 0.2 million, right? So the variational margin that we have for 0.2% will work in that case. So variational margin of 2% that we have, and which comes to around 0.2 millions as well, right? So till we are at this level 0.2 million, you don't need to basically make any kind of a payment, additional payment. The time that you breach that level, you have to fulfill everything from zero point 0.2 million. So suppose the value of the bond decrease from 9.8 to 9.5, so that's 0.3 million dollar. Now in this case you need to deposit additional 0.3 million dollar of either securities or 0.3 million dollar cash. Okay, and if the values similarly increase, you will get some cash back as well. And this is how margins and variational margin, I hope this concept has been clear to you. I have published all these things in details in the blog, and I will publish the link as well for the blog in the descriptions. So uh, do not worry about it. It's not an easy concept to actually understand it in one go. Anyway, let's move to the uh, different type of repos that are used in the uh, market. So repo comes in different form to meet the needs of various market participants. Let's look at a few of the most common types. First is classic US style repo. This is the standard type of repo. The seller temporarily transfer ownership of the collateral to the buyer and agrees to repurchase it at a future date. The legal ownership of the securities changes hand, but the seller is responsible for repurchasing them, typically at the slightly higher price. Now the next one is buy sell back and sell buyback. These are essentially two separate transactions, one sale and one future repurchase. The key difference between a classical repo is that legally the two transactions are distinct. In a buy sell back, the buyer retain any coupon payments made during the repo, but they compensate the seller for them later on. Now the third one is tri-party repo. In this type of repo, a third party, typically a custodian or clearing house, facilitates the transaction. This third party manages the exchange of cash and securities and handles margining part as well. The advantage of this setup is that it reduces operational risk and ensures that both parties meet their obligations. Now another type is cross currency repo. This is more complex type of repo. Here securities dominated in one currency are exchanged for cash in another currency. For instance, a European bank might use GBP denominated bonds as collateral to borrow euros. And because this happens between two different currencies, the added complexity here is that foreign exchange risk. It comes into the play because the two different currencies are at the play here. Now let's understand few of the repo trading strategies that are used. First is arbitrage between repo and cash markets. Traders often use repos to exploit price discrepancies between the repo market and the cash market. For example, if a bond is trading at a higher price in the cash market compared to the repo market, a trader might sell the bond in the cash market and buy it in the repo market. The profit from the price difference and the price difference will get reduced over the period of time, and this will give an basically risk-free uh, cash to the trader. This is also known as cash and carry arbitrage. This happens very rarely, but it do happens. Yield curve tradings. The traders also use repos to engage in yield curve trades. This involves borrowing short-term bonds through repos and using the proceed to invest in long-term bonds. If the trader expects the spread between short-term and long-term interest rate to widen, they can profit from the change in the bond price. This is a bit risky because if the situations gets changed, then you get exposed at both end, and uh, that's a very big risk actually, but people do trade on these things as well. Bond price anomalies. This is another strategy involving so basically it's take advantage of bond price anomalies. For example, a 10-year benchmark bond might be trading at a yield that's lower than similar bonds due to its liquidity or benchmark status. A trader could short this bond by a reverse repo while buying an off the run bond, that is a less liquid bond with a similar maturity, creating a relative value trade. As the yield converge, the trader profits from the price difference. These strategies are highly dependent on timing and require deep knowledge of both the repo and cash markets, as well as the movement in bond price and yields. Now let's understand the regulatory aspects of the repo market. The repo market has come under increased regulatory oversight, particularly after 2008 financial crisis. This is because repo transactions play a major role in liquidity issues that led to the collapse of some financial institutions. Since then, regulators have implemented measures to mitigate systematic risk and increase transparencies. Now let's understand the capital requirement that is imposed by the regulator. Regulations require bank and financial institutions engaged in repo transactions to hold regulatory capital against their repo exposure. This means that institutions need enough capital reserves to absorb potential losses in case the counterparty defaults. This reduces the credit risk involved in the repo transactions. Another one is leverage ratio rule. To prevent excessive reliance on short term borrowing, regulators have imposed leverage ratio rule. These rules limit the amount of leverage an institutions can take on by controlling the volume of repos they can execute relative to their capital base. This helps to prevent situations where institutions become over leveraged and are unable to meet their obligation. Market transparency. To improve market transparency, regulators require that repo transactions be reported to central repository. This ensures that regulator can monitor market activity, identify potential risk, and intervene if necessary. This was a significant development post 2008 as one of the causes of the financial crisis was the lack of transparencies in the repo market and its interconnectedness with other financial products. So repos are essential tool in both the normal and stress market conditions. During the normal conditions, repos are primarily used for liquidity management. Banks, dealers, and other financial institutions use repos to manage their short term funding need while holding onto long term securities. However, during the period of market stress, repos become even more critical. For instance, during the 2008 financial crisis and the COVID 19 pandemic, central banks like the Federal Reserve stepped in as lenders of last resort by conducting large scale repo operations to stabilize the financial system. By injecting liquidity through repos, central banks ensured that institutions had funds needed to meet their obligations and prevented a liquidity crunch that could lead to a broader market collapse. In these stressed conditions, repo rate can also be impacted. For instance, during the period of market stress, repo rates may spike as institutions scramble for liquidity. Similarly, haircuts may increase as lenders become more cautious and demand greater protections against market volatility. Now let's look into the last topic, that is the repo clearing. So repo transactions, like other financial trades, need to be cleared and settled. Clearing ensures that both parties fulfill their obligation, meaning the cash is delivered by one party and the securities are delivered by other. One of the most important aspects of repo clearing is novation. In a novation process, the central clearing house steps in and replaces the original contract between the buyer and seller with new contract. This means that instead of dealing directly with each other, both the buyer and seller now have the contract with the clearing house. This process greatly reduces counterparty risk as the clearing house guarantee that transactions will be completed even if one party default. We already have actually learned about novations earlier as well. The another feature of repo clearing is payment netting. Instead of each party having to settle multiple payments, the clearinghouse nets all the payments together, so each party only make one payment. This greatly reduces the operational complexity and risk involved in setting the multiple transactions. Collateral substitution is another feature of repo clearing. During the life of the repo, the borrower may wish to substitute the collateral provided with different securities of equal or greater value. This flexibility allows for more dynamic management of collateral portfolio. Now to wrap things up, repurchase agreement are an integral part of modern financial market. They provide short-term liquidity, facilitate complex trading strategy, and serve as an important tool for managing risk in both normal and stressed market conditions. By understanding the key concepts like repo interest, haircuts, margin, and repo clearing mechanism, we gain deeper insight into how repos help maintain the stability and liquidity of the financial institution. Repos also play a critical role in market regulation as they are subject to capital requirement, leverage limits, and market transparency rule. It aims to mitigate systematic risk and prevent market crisis. Thank you for your attention, and I hope that this session have provided you with valuable insights into the world of repos. For reference, you can look into my blog, and once you have went through the blog and the video, you can attempt the quiz to understand your understanding about the repos. Thank you and see you again. Next time probably we will be looking into the money market funds. Thank you. See you again.